Well, there may be some good news for cash-strapped consumers battling rising loan repayments. ABSA says we may have reached the end of interest rate hikes, could see cuts later this year. Inflation, too, seems to be slowing. Peter Worthington is a senior economist at ABSA and he joins me now. Peter, thank you so much for your time. We've seen a lot of very intense hikes over the past year. What gives you a sense that maybe we've reached the top and we're going to level off for a while?
So, as you say, we've had an enormous amount of rate hikes, but we're now in a position where the real inflation-adjusted repo rate is in positive territory. And that's a place that will leave the SARB Monetary Policy Committee a lot more comfortable. And then, of course, we have inflation, and it's coming down, mainly because of base effects on fuel prices. And we still have a little bit of upside showing up in core CPI. But by the middle of the year, we should have core CPI really reach a peak, we think, by the middle of this year. So those factors towards the end of the year, we should have headline CPI inflation back down in the midpoint of the target range, more or less, and core CPI having peaked. And we think that ought to leave some space for the SARB to consider some cuts. But I do think that there are a few things that also need to be in place in order for them to feel comfortable with that direction. So in general, although the picture is as we've described it, we do see some upside risks for our inflation outlook. And one of the most important, of course, is the impact of load shedding on the price dynamic in South Africa.
Yeah, exactly. I mean, I was going to say this all looks fairly good, but load shedding is, first of all, unpredictable and having a very serious knock-on effect I was just speaking to ABSA, their ability to produce food is at risk. We know the government has declared a state of disaster in part to support vulnerable industries, but it's remaining to be seen exactly what they can do and just how much more load shedding
averaging stage 4. We think it should improve somewhat over the course of the year. I think the big question for inflation specifically is we know that load shedding has landed on us. It is something that affects both demand and supply. Businesses are spending a lot of money on backup diesel generation, of course, and it's hurting their bottom line. They're going to want to pass some of those cost increases on to consumers. The problem is, for them, pricing power is going to be pretty weak because consumers are really embattled. They have taken a little bit of a hit to disposable income through the higher interest rates, but also a hit from the inflation that has built up over the last year and a bit. And we'll just have to see how able firms are to pass on those cost increases. I'm expecting that they'll have to take some of it into their margins. One of the other things that we want to see is in the upcoming budget. President Ramaphosa promised some support for businesses and households that are battling with load shedding. We don't know what the modalities of it are. We don't know whether it's going to be tax breaks for installation of solar or whether it's going to be a rebate on firms that are purchasing diesel, because if you're using it to generate electricity, why should you pay the road accident fund levy? We'll see, and we'll also see what the magnitude of it is.
Good question, actually, on the diesel issue. Speaking of fuel prices, we've seen some really hectic hikes. We've seen a bit of relief. It's kind of not as intense as it was. Your forecast is showing that there's a downward trend in fuel prices. How do you come to that? Because we are expecting potentially another fuel hike next month, aren't we?
Right. So it's not a downward movement in fuel prices. It's a downward movement in fuel price inflation.
Explain.
When we go into our forecast, yeah, it's an important distinction. It doesn't mean that prices are falling. It just means that after 12 months, a big increase, it kind of drops out of the year-on-year inflation calculation. The big question mark, I think, over fuel prices going forward is really what happens with our exchange rate and what happens with crude oil prices globally. We kind of operate with an assumption when we do our forecast. We use sort of a consensus view on where oil prices are going. But the global economy is doing better than people thought, let's say 3 months ago. We may end up in a situation where oil prices globally start mounting again, beyond the sort of the consensus view that we've embedded into our forecasts. And that's clearly an upside risk for the inflation trajectory. We mentioned load shedding. A third potential upside risk that we have is sort of early indications of an El Nino event. We don't know whether it will land hard or indeed even if it will land at all. If it does come, it looks like it's going to be something that's more for the end of this year, but could play out in 2024. But clearly a big El Nino, if it turns out like that, would be an upside risk for food prices and hence for headline CPI.
So would El Nino mean more droughts?
El Nino in South Africa typically means drought, yes.
Yeah,
it doesn't play out that way across the globe, but in South Africa, yes.
All right. So what you're saying to me, really, is that there's still a lot of risks. The load shedding is a potential risk, but you're looking at, all things considered, you're looking at fuel price inflation, which you're saying is stabilizing. We know, of course, that Eskom, of course, is going to increase our tariffs, though they have been asked by the president to reconsider that. You've obviously looked at all those pluses and minuses and still come to the conclusion as ABSA that we may have reached the end of the interest rate hike cycle. So talk to me about specific dates, because I know everyone with a bond is going to be going, right, so how long will it stay the same? When will it start dropping? Give me a month.
If I could be super prescriptive with 100% certainty, I would be a very wealthy man. But anyway, our view is as follows. We think that January hike was probably the last one, but we did acknowledge at the time that the risks were in the direction of perhaps one more hike in March. And actually what has happened with the exchange rate since then suggests that those risks have intensified a little bit. So we could get one more, maybe two, but we are, as I say, close to the peak of the hiking cycle because we now have the real repo rate in positive territory. And we are expecting a big decline to come through in headline CPI inflation. So the MPC can now kind of rely on declining inflation to deliver the increases in the real interest rate that it may need to control what's going on in the economy. We also see some risks to our forecast that there's room for the SARB to cut starting in September, but not a lot of cuts. We only have 50 basis points in. But I think, it is important to stress where the risks are on that.
Sure.
Very recently, we've had a bit of a shift come through in what markets are expecting from the Fed because the Fed has changed its signaling a little bit and is starting to say maybe we're going to have interest rates increasing higher for longer. I think our domestic inflation fundamentals would allow for a rate cut towards the end of this year. But in order for the MPC to feel comfortable about that, we would have to have had the Federal Reserve reach peak Fed funds rate by that time. If they're still in a hiking cycle of unknown duration and magnitude, I don't think we'll see a cut come through then. And linked to that, I guess, is the MPC would want to see the Rand trading quite stably at the time.
So maybe September, if a lot of factors align as you're hoping they will.
Maybe September, but the risks are that it gets pushed out into 2024, yes.
Okay, we're going to hold on to that potential good news. Thank you so much for chatting to us this evening. Peter Worthington, he's a senior economist at ABSA.